You're listening to Artistic Finance, show 145. Today we get an update on the Artistic Finance 6K, the $6,000 of investments we made in May of 2021. We're joined by a bond investment CEO, a data analyst, and 3 lighting designers to review how our investments compare to the S&P 500. Today we also discuss fees and how that plays into investing. Without further ado, let's get to the show.
You are listening to Artistic Finance, where we help creatives learn about the business of show business.
Welcome and thank you for listening. I'm Ethan Steimel, broadcasting out of New York City, and today I welcome back my superstar armchair investor panel, the CEO of the bond investing app Liquidify, joining us from Denver, Maithreyi Gopalakrishnan.
Hi, Ethan. Thanks for having me. It's great to be back.
Lighting designer and project manager, joining us from Los Angeles, Ebony Madry.
Hi, Ethan. So happy to be back here with y'all.
A leader in data and analytics at Worldwide Wickets Financial, joining from St. Louis, Missouri, Katie Buhrman.
Hi, excited to be here as always.
And founder of the Financial Independence Book Club, Amy D Lux, joining us from
Austin, Texas this time. Thanks for having me.
All right, amazing. We're recording this on May 7th, 2023. And before we start, a few announcements, because this year the review falls around a few birthdays or a couple birthdays. First, Katie Buhrman just had a birthday. Happy birthday, Katie.
Thank you. And you just had a birthday as well yesterday. Happy birthday, Ethan.
Thank you. Thank you. And one more birthday, that is Artistic Finance is turning 3 today. So congratulations. And I just want to say, at this point, we have 36,000 downloads, and we've broadcast in at least 88 countries. I didn't quite count them all today. But outside of the U.S., our biggest countries for listeners are the U.K., Canada, India, and France. So thank you to everybody who's listened, and thank you to everybody who has supported us. And now there are a few super listeners out there, and you know who you are. But these are all people that have gone beyond listening and have done other things like become patrons, given us shout outs on social media, told their colleagues about the show, bought our overpriced swag, assigned episodes as homework for their classes, which is my favorite thing that anybody has ever done. And then, of course, the people that have given me feedback and suggestions. So thank you to everyone who is a super listener. Katie, all right, we're going to have a financial discussion today. So can you give us a disclaimer?
Yeah, of course. So none of us are financial professionals. None of what we're talking about today should be taken as advice or personal recommendations. If you are looking to make decisions about your financial well-being or whatever that might be, you need to seek a professional before doing so.
Amazing. All right, and I'm not going to explain the backstory of why we're all here today, but if you want to know more about what we're doing, go back and listen to previous episodes that are titled The Artistic Finance 6K. All right, so does anybody know this first question I have, which is, what is the state of the market today? I genuinely don't know.
You have dad brain right now, so that's like, I think you can get away with it. You're like, oh yeah, I don't know anything in the world. There's like a baby at home.
I'll just say what I do know, and that is that the Artistic Finance investments we have, I think, went down from last quarter.
It was up in January, down in February, down until late March, up again a little bit, and then now it kind of came back down for the last week. So yeah, you're sitting on a sad past week, but hopefully it'll get better again soon.
All right, I have to pull up the Artistic Finance, the numbers. Okay, so I'm just going to go over the investments that I picked for Artistic Finance. So we invested, for all intents and purposes, $5,000, and we now have $4,400. So we are down overall 12%. So let's break that down. So we bought the S&P 500. which is our standard measuring stick, that is up 4.3%. We put 1,000 in, we now have $1,043. All right, that's great. That is the only one of our investments that is up, which is like the age-old wisdom of go with the S&P 500. All right, so the 4 stocks we picked, we have one Skills, which is down 96%. We have an energy company, VST, which is up 46%. We have a lithium ion mining company, which is up 41%. And we have Blue Moon Beverage, which is TAP, and that is up 20%. But overall, the stocks I picked are down 8%. Okay, so then we go into real estate, which I always expect to be just like a steady dividend-getting thing. We have 4 REITs. UBA is up 31%. SRG is down 56%. STAG, STAG is down 4%. And then VICI is up 18%. So overall, I am down on the REITs 0.1%. So basically even for REITs. But I expect those to never go negative, so I'm sort of annoyed at that. Bitcoin is down 50%, but that's the best it's ever been on any of these quarterly reviews. So my best performer was Bitcoin, which went up 10%. So it went down from a 60% loss to now just a 50% loss. Now Vinovest. So Vinovest is the case of wine that we bought, and it has been steady and good the last few times. But now our $1,000 that we put in is $958. So we're actually down 4% on the wine. And just a reminder that the wine has the highest fee. We pay a 2.5% fee on the wine that we're holding. So not only are we down 8% behind the S&P 500, but we're also paying like, I don't know what that is, 20 times the fees that we're paying on the S&P 500 ETF that we have. Okay. And then the art that we bought, I don't count, but we paid, let's say, $1,000 for that. And for all intents and purposes, the return on that has been 0, and I expect it to be 0, but I don't really count that. So yeah, that's how I got to be down by 12%. Which, let me just point out, this hurts me to point out, if I'm down by 12% and the market, S&P 500, is up 4%, I'm really trailing the market by 16%. So it's even worse than the 12% that it sounds like. So anyway, that's how I'm doing. And I don't plan to rebalance everything. I'm going with that investor, Ian Dunlap, who says just buy it and hold it for 10 years. So I'm hoping, like we're starting year 3 right now, not so good. But I'm hoping at the end of 10 years, I'll be happy. Because that's what he says. Buy it, hold it for 10 years, and I'll be happy. All right, so now to the group. Let's move on from my picks. Can you guys update us on your investments?
I can jump in and go first, if that's all right. So I think for the purposes of this experiment, I'd use the JP Morgan bond and the I bond. I know the JP Morgan bond is down a little bit because bonds have actually been doing well. So then when I bought the bond last year, it was maybe a little early to buy it. So it's down like, I think $20 from the 1,100 or so maybe dollars that I paid for it. But I'm holding it for the coupon payments and then getting the money back at the end. So I'm not super concerned about that. The I bonds though, the rate got reevaluated for this coming 6 months to, I want to say like 4.5% or maybe even less than that. So in its heyday, it was like, 9.6 something percent. It was very exciting. But now the coupons are down to actually 4.3%. So not yielding quite as well as it did in 2022, but that's okay.
Wait, can I interject here?
Yeah.
So Amy D Lux has a book club that I attend. And in one of the books was talking about high interest yield savings accounts. Anyway, so I'm just going to say that I switched our savings into a high interest yield account, and it is now getting a 4.65% return, which to me is equal to your bond or an I bond, right? So,
yeah.
Question for you, Maithreyi. Am I better off in bonds or in a high interest savings account?
It depends on the type of bond. So the thing with the I bonds is that inflation was really high when that 9.6% rate was there. But now inflation's actually come down quite a lot. And so the I bonds rate gets affected by the rate of inflation. And so now it's not so good anymore because inflation isn't so high. But treasury bonds right now, like shorter term ones especially, are actually yielding like, I think 5.2% or higher. And those are super safe. Like they're the safest kind of bond you can get. So it's not a bad option. There's also tax advantages with treasury bonds if you live in a high income tax state like New York, I'm guessing. So yeah, so there are some advantages to certain types of bonds, but I'd take a high interest savings account over an I bond right now for
at the
sure.
moment. But I will say that the bank or whoever determines rates, et cetera, could stop that at any moment. Like, because I think I only started it a month ago and it was at 4.4 and now it's at 4.65. But that's just on the whim of them.
Yeah. They have to be competitive with the rest of the market. So they will, adjust based on what other banks are doing as well. But it's definitely the whims of the bank.
Awesome. Yeah. Okay. So overall, are you happy with how your bonds have been doing?
I'm pretty happy. And I got some treasury bonds and those are doing great. So I'm happy about that.
All right. Nice. All right. Any who else wants to go on their investment?
I should go before my jet lag kicks in and I can't even function anymore. So I'm the one with the weird one with the Masterworks where it's like you can't actually track it. So last time we had a bunch of questions and I did do some research to understand how that works a little bit better. And one of the questions that we had was how often are they appraised and kind of how does it work? So I found out that they are appraised once a year, but they can also be appraised more times if something similar is being sold on the public market. But generally speaking, they're going to be sold once a year. So the last time we chatted, I had my Bridget Riley and my Kusama, and neither one of them had been appraised since I bought them. Kusama was actually just appraised. So I have a little bit more information about that. But the other thing that is really interesting that I found out as far as how Masterworks calculates the costs once they're purchased, they calculate it on an all art index where the contemporary art prices have, and they have gone by a Deloitte report. And just historically speaking, that contemporary art prices have outpaced the S&P 500 by 131% in the period of 1995 to 2021. So historically, that's kind of a really big differentiation there. And based on the Deloitte report, the total value of privately held art is valued at 1.7 trillion. So just to kind of give us some scale. And then I found a Forbes article that goes through the details as well as when and how they sell. And Masterworks can take 3 to 10 years before they'll sell work from the portfolio. So it is a buy and hold strategy. And according to Masterworks as well, the contemporary art market delivered an average annual return of 14.1% over the past 26 years. And that statistic is as of November 22nd from 2022. So a great return, 14.1 is pretty high. So one of the things that was, I was kind of stagnant in being able to know if my pieces were gaining or losing value, since it takes several years before they're going to sell a work. And that's made it a little bit tricky to evaluate. So Masterworks just recently actually added the Sharpe ratio metric, which has been super helpful. I didn't really know what that was before, but basically what it is it measures the performance on a risk-adjusted basis that an investor needs to take in order to get that performance. So if the ratio is greater than 1, then the returns have been higher than the amount of risk taken. So generally speaking, the higher the ratio, the better the risk-adjusted returns. And if they're lower, then it's not as good. So many investments like the S&P 500 have Sharpe ratios that are less than 1, which means the returns have not been as high as the risk taken. The current S&P 500 portfolio Sharpe ratio is actually negative 0.10. And so a negative Sharpe ratio means that the risk-free rate is higher than the portfolio's return. Again, a Sharpe ratio greater than 1 is considered acceptable to good by investors. So the current portfolio that I have, which is the Kusama and the Riley, I have a combined Sharpe ratio of 1.24. So that is very good. And it's actually on the upper decile among all Masterworks investors. So I have a good portfolio going so far. And the Kusama finally stabilized after 2 years. I've had that one for 2 years. Bridget Riley, I've only had for, I think, about 6 months. So that one's still in its early days. It hasn't been appraised yet. But the Kusama was recently appraised with a 32.5% increase in value. So that is very good. And that is making my portfolio generally stronger. So that's kind of the best stats I can get now. But at least I have something to go off of. Obviously, I'm going to buy and hold these until they sell. So I have, 25 shares of each, which I originally bought for $500 each for a combined of $1,000 in Masterworks portfolio. Now, if we want to get embarrassingly interesting, as I said, I'm typically a set it and forget it. So, usually it's my index funds and everything just kind of sit there forever, buy and hold, to the point where I completely forgot about one investment that actually should be in this group, I think. I don't want Ethan to be the only one embarrassed about his crypto. So I have not been on board with crypto. I have not felt comfortable investing in it because there's a lot of speculation. It's very complicated to me. And I see that there's some kind of something going on. There's some kind of value. Like a lot of people are doing it. I think El Salvador even has made Bitcoin an official currency. So there's something happening, but to me, it's a little bit difficult to believe in and put my money into. So what I did, I think this was last February-ish, Coinbase went public. And when that happened, I thought that might be a good way to dip my toe in without actually being in crypto, because Coinbase is basically a brokerage for crypto, and them going public means it's in the regular stock market, which is the one that I understand and feel comfortable with. So the day that Coinbase went public, I bought 3 shares. And I totally fell for the hype, right? Because they were $333 each. So I bought $999 worth of Coinbase. And then over the next month, it completely dipped. And now, it's been, I think that was last year. Yeah. So it's been just over a year, and it has gone down where they are now valued at $58.24 each from the $333 that I bought, which is, instead of my portfolio being the $999 I bought, it is $191.90 with a drop over all time of $807.10, which is an 80.79% loss.
Yes. Thank you, Amy. Yes.
That
is awesome.
I completely ignore this thing. I'm just okay. And you know what? Also, it's in a Robinhood account, and I'm totally not on board with Robinhood anymore either for a number of reasons. And you can actually buy Coinbase and Vanguard. And if I could, I would even just move this into my Vanguard account, but it's so crappy. It's not even worth selling and rebuying. So I'm just going to leave it in there and let it suck until
but isn't that how tax loss harvesting works? I mean, technically not, but I suspect nobody would count it, and therefore you could get away with it. Maybe, but you sell it there and buy it in Vanguard. I mean, this is not financial advice. I don't know. That is awesome. Okay, so my only stock that is lower than yours is Skills, which is at a 96% loss. But, oh, Amy, I'm so glad you shared that. Thank you.
I know you needed something to cheer you up today, so there you go.
That is awesome. Okay, and then the Sharpe ratio for your artworks, who determines the Sharpe ratio on those?
So I mean, the Sharpe ratio, there's actually a formula. I think I closed that window, but it's risk, what it's cost times the risk divided by a thing, and
but somebody else is determining that
down
for you? Like somebody else has determined it?
Yeah, they did it and they just put it into my portfolio, and there's, where all my statistics are and everything. But the ratio itself is just, is known. And then they do that and then they put it into my portfolio stats. And now when you go to the new offerings at Masterworks, they are presented with the Sharpe ratio and a lot of other data that wasn't there before. In the beginning, when I bought my pieces, it was like, here's a Kusama, here's information about the artist. It did kind of show like what it valued over time already. But now with the Sharpe ratio, there's other things to compare it to. You can evaluate your risk, and you can actually change your entire portfolio by buying something that has a higher Sharpe ratio if you have a lower combined Sharpe ratio. So you can increase your overall portfolio by bringing in pieces with higher Sharpe ratios. So it does help to analyze, your next purchases.
Got it. And it was also interesting that the S&P is at a negative Sharpe ratio right now.
Well, and when I watched their kind of like video about this is how to understand what a Sharpe ratio is, they use, as everyone uses the S&P 500 as an example, and they also said like similar types of investments and assets, and the average then was like 0.55. And, I just looked it up today, right before the meeting, just to see what it was currently, and was really surprised to see it was negative, because I think that's kind of uncommon. So that might be another indicator that the market's like kind of down this week.
Right. Gotcha. I love how we're all here and we don't know how the market is. We think it's bad. Cool. All right, Amy, thanks for that. Ebony or Katie, one of you want to update us on your investments?
I'll go next, I guess. So I'll say overall for, I guess, the full year now, because we're like at our 1 year mark, I'm at around a 13% return across all three of the things that I did. So I had, which is down from, I think the first quarter was my highest at like 20%. And then it has only like gone down, but it's still a positive return, obviously, and still higher than the market. So I guess I'm doing good.
Well, so far, I mean, Amy could be at 30%, but it's sort of, since she's buying and holding, we don't really know. Yeah. So technically 13% is the highest of any of us at this point.
There you go.
So congratulations.
Thanks. So I'll say my worst one continues to be PayPal. It has only continued to decline, I think, since the first quarter it was positive, but since then has only lost money.
Note to self, Katie keeps updating us that PayPal keeps going lower. So Ethan at some point is going to need to buy some PayPal. Good.
Exactly. I need to buy it. I mean, it's like, I don't know, like part of me is like, oh, I should just buy some more now because it's so low, but also it has not done well for me. I've like bought it a couple of times over the last couple of years and sold it for tax loss harvesting and then bought it again thinking like, oh, it's low again. At some point it's going to start going back up, and it has not yet. But we'll see. And then my other two were mutual funds, and both of those have obviously done really well and kind of made up for the loss that I had with PayPal. So, got some dividends each quarter, I think, from both mutual funds. So that's good. And reinvested those. So I calculated that as part of my return. But
awesome.
Those have continued to do well. So
fantastic. All right. Congratulations.
Thanks.
All right, Ebony, we're all waiting to hear how Tesla's done.
So since then I also did an investment in Kroger, like the grocery store. And they're both doing very well. I expected Kroger to do well. Like, people need grocery, people are shopping. But Tesla's also doing well. It wasn't, I would say in the last like week or so is when it started to bounce back. Like last month, and then the end of the previous month, it was like looking really rough for Mr. Elon. But since then, it really has bounced back. I'm at a 8% up. And my Kroger investment, which I just literally did like maybe about a month ago, that's at 11%.
Oh, wow.
So, yeah.
Okay. And just out of curiosity, does Kroger have a dividend?
I don't think so. I don't think they have.
Okay.
Yeah. I didn't really look too far into it. I was just like, I have a little money in this account and I want to put it somewhere. And I felt like Kroger was like a safer option out of everything that I was looking at the time.
Mm-hmm.
I almost did Target, but I ended up going with Kroger.
Nice. Okay. Well, Tesla, which you've had for the whole year, that's at 8%. Great. And then Kroger, 11%. Awesome.
Yeah.
Wow. Everyone. Great work, everyone. Okay. So maybe I should have asked this question. No, I'll just ask this of you, Ebony. Are you planning on selling out or holding those? Well, does anybody have any plans to do anything other than hold? Okay. The whole group is holding. Yeah. Okay. All right. I want to take 1 minute and talk about the Artistic Finance Patreon page. And really, all I really want to say is that Heather Gilbert, who is our patron, was nominated this week for a Tony Award. So
That's awesome.
she did the lighting for Parade. So she was nominated for Best Lighting Design of a Musical. So good luck. No, break a leg, Heather, getting that Tony win. But that's amazing. And then I also just want to point out that we actually have a lot of previous guests who were also nominated for a Tony, which, by the way, if you're listening, you have not become a patron, but I will forgive you. But all these previous guests have been nominated for Tonys. Jen Shriver for Death of a Salesman, Lap Chi Chu for Camelot, Ken Billington for New York, New York, and Greg Barnes for Some Like It Hot. Break a leg, everybody, and especially Heather, who is my favorite nomination of the batch. And if you are interested in becoming a patron, you can do so at patreon.com/artisticfinance. And now we can get back to the investments.
I actually just pulled up the market summary for the S&P 500. So I think it's very interesting because the market always goes up and down. And so when you look at the market summary, it's not as bad as everything has seemed the past few months, even, I think, right? So for the past day, it is up 1.85%. The past 5 days, it is down 0.73%. And then it's up. It's just the month is up 0.66%. 6 months, it is up 8.05%. Year to date, it is up 8.16%. Past year is up 3.63%. And the 5 year, it's up 51.64%. So overall, looking really good, I think.
Yeah, it is. And I think last quarter it was down a little bit because my investments were all beating it.
Yeah, and probably those 1 day, 5 day, 1 month, markers at that moment were down. But that's why the charts always look like a zigzag, because it's always up and down. But if you look at it in the short term, it looks like it's bad. But then if you look at the long term, it's good. Yeah,
and that 5 year gives me hope because we've had it for 2 full years now, and we're at 4.3%. So I'm looking forward to that 50% over 5 years. Yeah. It's going to catch up. Okay, so I also want to talk just a little bit today before we leave. I want to talk about fees because this came up during book club, and I've just been seeing a lot on Instagram from financial people who are being like, stop paying fees for your investments. So I just want to figure out what we're all paying for fees. Before that, I looked up like how important fees are, and I got to an article by Vanguard, which is of course our low cost ETF solution for the world, and they have a little chart and an article about it that I'll link in the show notes. But the chart says costs can eat away at your investments, and they say if you pay no costs for your investments and you put in $100,000, by the time you reach retirement, you could earn $330,000, like using an S&P return. Okay, so $330,000. Then it says if you pay 2% in fees for that same $100,000 investments, you're going to earn that same amount, but you're only going to keep $160,000 of it because $170,000 would be pulled off for fees. So that's just a really powerful chart to look at. And then another thing they pointed out, which was funds with lower costs have outperformed more expensive ones. And this isn't one I had really thought about or knew about. But so it says the average yearly return on US stocks is 7.8% for funds that don't have expense ratios or have low fees, low expense ratios. And it's only 6.9% for funds that have higher fees. So I don't know exactly why that is, but that is data driven, that you can get 1% more return if you have a lower cost index fund. And then they did it for bonds, Maithreyi, and the yearly return average on bonds with no fees is 4.4%. And if you have a bond index that has higher fees, it's only going to be a 4% return. Okay, so and then I asked ChatGPT about fees, and this is what Mr. ChatGPT told me. The 5 reasons to watch out for fees, and that is fees can eat into your returns. So when you invest, you're aiming to grow your money over time, but fees can eat into your returns, reducing the amount of money you earn. Number 2, fees can vary widely. So different investment products such as mutual funds, ETFs, and individual stocks come with different fee structures. And I think that's a good point because in this investment strategy for all of us, we all have very different investments. So our fees are going to vary widely, and we're going to get to that in a minute. Number 3, fees can compound over time. Even small fees can add up, especially when compounded over many years. For example, a 1% annual fee on a $100,000 investment can result in a loss of $28,000 over 20 years. So I don't know exactly where Mr. ChatGPT pulled that stat from, but it sort of matches what the Vanguard data was saying. Number 4, lower fees can lead to higher returns. And this is that other chart from Vanguard showing that if you have a lower fee fund, it's going to perform better than the higher fee fund. And then number 5, fees can impact your financial goals. If you're investing for a specific financial goal, such as retirement, high fees can have a significant impact on whether you reach that goal. By choosing low-cost investment options, you may be able to stay on track and achieve your financial objectives. So I went to look at the fees that all the artistic finance investments had. And so our S&P, we have an iShares fund, which at the time that I bought had the lowest expense ratio. Oh, by the way, expense ratios can change. So if you buy it at a certain time, it may have a lower one or a higher one. So anyway, at the current time, ours is 0.03% expense ratio, which is pretty good. I would say that's comparable to Vanguard, though Amy might disagree, but we'll see, TBD. And then the other thing is that all the other investments we purchased were actual stocks. And even the REITs, I thought those are sort of index funds, but they're actually just companies that own a huge portfolio. So that being said, there are no fees for those, even though it's up to like the company. Obviously, the company has costs, and we don't really know how they're managing their money. But anyway, for all intents and purposes, none of the other things we own have fees. But the wine, as I pointed out earlier, that's a 2.5% fee. So that is a very high fee, but in my brain, it's sort of worth it because I wanted to buy wine and I wanted to see how that investment goes. So I went into that knowing that that was a high fee, but that is very significant. That's even higher than the Vanguard article that said 2%. That they were using that as an example of high fees. And here 2.5 is even higher than that. And then I just want to point out that Bitcoin, when you buy Bitcoin, I want to say when we bought the $1,000 of it, there was like a $21 fee. And that was just, I don't quite understand how it works, but whoever's actually doing that data crunching gets paid a fee. Now that varies, so there's no way to really know what that will be when I sell it, but I suspect that the market rate is going to keep those fees pretty low. But anyway, but I'm just pointing it out because there would be a transaction fee when we sell the Bitcoin. All right, so can you let us know what fees you're paying?
For the corporate bond, I know I paid a fee. I honestly can't remember what it was or find the receipt that tells me what it was, but I don't think it was significant. It was like a few dollars, like under $10 on the $1,000 purchase. I think that's relatively standard for corporate bonds to have a fee on it. Treasury bonds don't usually incur fees. I'd be suspicious if you had to pay a fee on a treasury bond. And then of other investments that I have, like I pay maybe a maximum of 0.10 or 0.15% on some index funds or like ETFs. And those are like more ultra specific ones. But for the total market types of ETFs or funds, I think the 0.03% range, like what you mentioned, Ethan, is pretty reasonable. So one other thing I'll just make note of is that there are different ways that different brokerages approach fees. There's been a lot of popularity around the zero commission model. And I think Robinhood kind of champions some of that. But that may or may not, depending on the type of investment you're making and how much you're investing, it may or may not be the best for you, because there's also like what the actual price you get it at in the market is. And so you might be paying no commissions, but then you might get a not great price of execution. So they won't get you the best deal possible. And that might outweigh the additional fee you would have to pay to get the best price in the long term. So that's just something to note about these that I thought was really interesting when I was selecting brokerages. So
Wait, okay, I just have to ask the question. What is your brokerage?
I do my personal brokerage with Schwab, but for my investment management clients, I use Interactive Brokers, and they do have that flexibility to choose Interactive Brokers between a zero commission model and a model where you pay commissions, but you get best execution price. So I guess two, but for different purposes. But I like Schwab and Interactive Brokers for different reasons.
I do not know what Robinhood's is. I was just trying to find it. I'll have to come back to that one. But I switched over. So my Vanguard, which we're not even really talking about on this one, but that's 0.08%. That's my real pony there.
Wait, your S&P 500 is 0.08%?
It's VTSAX. So it's an index like the S&P 500, but it's not S&P 500 directly. Yeah, so I've got it 0.08%. Industry average is 0.47%. And Masterworks, I'm going to have to find that one out too, because that, I think, happens at the sell, and I don't have that information right in front of me. So,
okay, but Masterworks, they're taking their percentage probably whenever you sell or buy, but they're not like charging you an annual fee or anything.
No, I don't think so. No,
I don't think so either. Cool.
I've got homework again. I'll let you know next time.
Okay, and then that nice Coinbase you told us about, that's an individual stock, so there's no fee there.
Well, that one's in Robinhood, and yeah, it's an individual stock.
Cool. All right, Katie.
Yeah, so I'll say I'm in a little bit of a unique situation because of the fact that I'm employed at my brokerage firm. So I get certain things differently than somebody who's just a client there would. But I will say, so with PayPal being an individual stock, I do still pay a commission on that. But I think it's $15, which is, I know, really high for like considering the no commission online game right now. But that's just when you buy and sell. So obviously as an individual stock, no like ongoing fee with that. On my mutual funds, one of them, the expense ratio is 0.8% and the other is 0.59, which both of them less than 1%. I know still not as low as index funds and things like that. Although I would argue maybe like similar to my trace point, like even though you don't know the return you could get, I think of it as kind of like leveraged investing. Like I'm getting a better return, at least right now, than I would have gotten on those index funds, even if you net out the expense fee. So in my case, it feels like it's worth it. And I don't pay, as an employee, I don't pay any upfront commissions on mutual funds. So I just pay like NAV. So in my case, a lot of times like it can be beneficial to do mutual funds, even though like I use Personal Capital, which is now Empower, for like my personal finances, and it yells at me all the time, like, look at the fees you're paying. And I'm like, I can't do anything about that because I'm not allowed to invest anywhere else because of regulators and things like that. So it's, good or bad, but I do feel like right now, at least, I'm getting a better return because of that. So I know the fees are a little bit higher, but I think it's worth it in my case.
Yeah, well, I just want to point out, and I was hiding this from Amy on the last book club episode, but I'll come clean now, which is that Nicole and I have a financial advisor, and they're getting 1% roughly. Like I went back and I just added it up, and I was like, it's about 1%. So on our actual retirement funds or broke, whatever that is, I am paying a 1% fee roughly. But I was prepared to defend myself. So I need to talk to our advisor. But I did notice that there was, I think, some tax loss harvesting that happened, because on our taxes, I was looking over our taxes, and from the brokerage account, which we don't sell anything out of, like we just buy and hold, as far as I know. They say they do some things, but I don't check. But there was the 1% we paid, there was 5 times that amount in a loss. And so I'm just saying that we never would have done the tax loss harvesting, and they did it. So I don't know if that justifies the 1% fee, but in theory, they got us a ton of money off on our taxes for that fee. So I'm just throwing that out there.
Yeah, and I will say to that point, even though, again, my work situation kind of dictates that our financial advisor that we have did the same thing for us. Like I had not been tax loss harvesting prior to having an advisor, and they've pointed out those opportunities for us in several cases, which has saved us money. So I think that's also kind of made up for it in a lot of ways.
Yeah. All right, Ebony.
All right. So I would say I'm using, honestly, I use Stash and Robinhood. I've been wanting to switch over to like a adult system with swabs. I've actually been looking into them. But yeah, I'm on Stash and Robinhood, so I currently have no fees associated.
Okay. And I should also say that because I spread out the artistic finance investments everywhere, 20% of them are in Robinhood. Mm. So I do Robinhood and Webull and M1 Finance, which I think are all commission-free things. So take it or leave it. All right. So fantastic. Does anybody have thoughts or want to mention or talk about fees at all before I move on? Okay, good. Amy didn't want to say anything. Perfect.
I wanted to mention, though, I think what Maithreyi said, though, like, I had been thinking about that, in the fact that, like, you're not, in using, like, a Stash or a Robinhood, you're not necessarily always getting, like, the best price. Like, they're not necessarily fighting for you in that essence. So that's really why I had been wanting to start like switching over to like a Schwab or like a Vanguard or something similar, because I felt like when I was looking at other things, like, why don't I feel like I'm getting the best price?
I will say my workaround for that on Robinhood, because I noticed that early on when I used Robinhood, I was like, hey, the market rate says this. And yet somehow when I click it, it's a little like I'm not getting the best deal here. Mm-hmm. So what I do is I only do limit orders. And even if that limit order is saying the price that it is currently. Mm-hmm. And so that's my workaround, to be like, okay, I'll at least be guaranteed to get it at the price that I'm seeing now, just because I don't trust Robinhood at all. And I trust very few people and things.
Right, right.
You trust your financial advisor. I'm just messing around. I am not a financial advisor, so I would never tell you what to do.
I'll just say we have to trust some people, because we can't do everything in our lives.
It sounds like they're optimizing for you.
Yeah, we'll go with that. I've been meaning for a couple years to have a chat with them about what's going on. All right. So what have we learned from this investment experiment? I ask this every time. So for me, this time around, I have learned that I should just stick with the S&P 500, because it would be less stress. It doesn't seem to be doing better than everything. It is doing better than every single thing that I have chosen. If I were to do this all again, I would just get the S&P 500 and ride it out, baby.
I was going to say the same thing as you, Ethan, actually. I think there have been some experiments where people just buy the S&P 500 versus making some complicated portfolio and just hold it for dozens of years and see what happens. And the S&P 500 usually does win out. So I think if you're not investing for like a specific goal with a specific timeline or something like this, and you're just riding the waves of the market, so to speak, the S&P 500 is probably the way to go. So I second you on that. That was a good learning. And to see it, just how it's performed over the past 2 years was interesting, because like over a quarter, you don't really see much, but over 2 years, you really start to see that pattern. Okay, this is the long-term kind of buy and hold sort of thing. So
yeah, and I think next time I want to add in a global stock market ETF, because I'm thinking like there are listeners that are outside of the USA, and I don't know if those listeners can get the S&P 500. They probably can get something similar, but I sort of want to loop in an overall global index, because I imagine it would perform similarly to the S&P, but something that everybody in the world could have access to.
I think that's a great idea. I learned a lot, actually, thanks to this group, asking me about it last time. So I learned a lot about Masterworks and how it works. And I actually feel even more confident now in the investment with Masterworks. And just as I learn more about the high returns of the art market and their methodology, I think is really great. So I'm still index funds for life, but as far as like a side hustle goes, so to speak, feeling really good about the Masterworks investment.
Yeah. So for me, I think this has more like validated, I guess, funds in general for me, like both mutual funds, index funds, ETFs, like anything that's more of like a blended investment, and how well those can really do. I feel like I've historically always been more interested in stocks because it feels more like personal, I guess, and like you're close, like more about exactly where that money's going and what that company is as an individual company. But in the funds, it's a little more. Like, I know you can always look up the holdings and all of that stuff, but it feels a little bit more black box to me, and so less exciting in that way. And yeah, like I said, less personal, but generally, understanding that it's a diversification play, and obviously there's a lot of benefits that go along with that, and it can, obviously they perform well over time. So
yeah, and I'm glad to have you here with the mutual funds, because like over the course of our last 145 episodes, we did have a couple people who defended mutual funds and explained like, well, some of them can actually have lower costs. And then we had the most recent book club with Amy, and in there it was very like, no mutual funds, no. And it explained like tax reasons why you shouldn't have them. And so then I was sort of like returning to that home base of like, oh yeah, ETFs are what we should do. But as Katie, you're pointing out, and also us with our financial advisors that charge fees, there's like a time and a place for everything. So if you're listening to this and you have a financial advisor and you're paying a fee, to be fair to that advisor, they are doing a job and they are helping you. So it's like, it's not like you should be embarrassed. Like, yes, do look at it and consider like, oh, could I save on fees? And would that be a good idea? Like, looking back at the last 5 years of what your advisor has done, could you just say, oh, this is what they're doing, I could switch to no advisor and still continue that path? And if so, like maybe go with it. but also like you don't need to feel like ashamed or like your life is going to end because you're paying fees or because you own a bunch of mutual funds, especially everybody in their, 401ks or the investments that we have access to that we don't control, like the IATSE funds or the USA 829 pension. It's like we don't control that. We don't control the fees, but we can see them and we know they're there. But just because of that doesn't mean like you're bad at finances.
No, and I think it's important to get into the market as opposed to not doing anything at all. And if your entry is that you need someone to help you, I would say let somebody help you, but just make sure you're also learning so that over time you can optimize or you can pivot and you can adjust as needed so that you are paying the least amount of fees as possible. But if the choice is I'm going to either get a financial advisor and pay a fee, or I'm just not going to invest because I don't understand it, get an advisor and pay a fee, and then learn while your money is actually growing.
Exactly. Yeah, that's exactly what I was going to say was, in a lot of cases, people pay a financial advisor to pay attention to the market so they don't have to, because they either are not interested in learning more about investing or just don't know where to start and all of that stuff. So there can be benefits, to that knowledge and that arrangement. And to your point, you should want to take an interest in learning because you want to know where your money's going. And any good financial advisor is going to be transparent about their fee structure and how they're getting paid. And so you should ask questions and you should question that if you're in a situation where you feel like that's not paying for itself, that relationship is not paying for itself. And again, any good advisor is going to answer your questions and make sure that they're making the changes necessary to make you feel comfortable. But if you're somebody who is super interested in the market and feels like you're knowledgeable enough to make those decisions for yourself, paying for a financial advisor may not be advantageous to you because you aren't necessarily getting added value there. So it's all about what you're getting from the relationship and whether or not the value is worth the cost.
Yeah. And I want to just throw this out to the group, which is we have a patron named Savannah Bell, and they contacted me a while back and they said, hey, nobody's talked about robo-advisors. And so I wanted to do a whole episode on it and I was having trouble finding a guest. So anybody listening, if you know anybody that could talk about robo-advisors, but I would also be interested in adding a robo-advisor situation to this investment experiment. So if there's somebody listening that wants to take $1,000 and find a robo-advisor and like stick it with the robo-advisor and see how that progresses, reach out to me because that would be cool to have you join in here.
I think really for me, it still is just like holding on and being patient with everything, just because I do. In the past, Ebony would have, whenever Tesla dropped, I would have started like partialing it out. Like I would have been like, okay, I'm just gonna sell like a part of this just to try to feel like I could get some money back or make something off of it. So just reminding myself to be patient in it, and that I still need to get some investments started in an S&P 500 because I need to do that.
That good old S&P 500. I'm actually, Ebony, I'm really glad you said that because I think I'm maybe the opposite of you. Like I just want to set and forget forever. But it's been good to see you because I consider you like Wild West, like boo, 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 here we go. And so to see you have that like takeaway, I'm like, okay, wow, we're all like, I can actually see changes from, us as we all progress. I'm like, oh yeah, maybe I would do things differently. Cool. All right. So I also want to mention, because I know Maithreyi has some wine and we have our wine investment. So Vinovest, which is where that wine is invested, they recently changed how they do business. So previously they were a buy and hold strategy and they would recommend to you when to sell. So you would buy a case of wine, you would hold it for however long you want to hold it. Anyway, I'm just pointing this out because they changed their strategy and to what now they automatically default you. And if you don't opt out, they default you into this thing where your case of wine, they're going to actively manage it. And so they may randomly choose to sell it because it's a good time. And then they would take whatever that money that you still have and they would reinvest in something else to hold. So that being said, we had bought a case of wine and they opted us into this automatic like they could just sell it whenever they want, which is not what I signed up for. Even though it may be better for them, and clearly they think that's better for everyone. And I'm only putting this out because a listener had said, hey, by the way, they switched me, and then I randomly saw that they sold a case of mine for a $700 loss. And maybe that's a tax loss harvesting situation going on there. I don't know what Vinovest is up to, but I went to check mine and they had opted me over. And so I emailed customer care and I was like, hey, I would like to revert back to the old system, even though technically I missed the deadline. But they responded and they said, we will put you back on the old one so that you can buy and hold your case of wine. So anyway, I'm just saying this is like my PSA, my public service announcement to the world. If you have Vinovest, like, just keep an eye on that.
When did they make that switch? Can I still email them?
Yeah, well, I emailed 2 days ago, and
okay.
They said, we're working on it. I logged in today. I think they haven't switched me back yet, but I believe they will. Technically, the deadline was like April 16th, so I had missed it. Last question for everybody, which is, can we get an update on your career or finances in your life or just your life?
So let's see, career-wise, things are checking along as I'm kind of growing the investment management portion of my business. Have gotten a couple new kind of clients that I'm onboarding in the coming weeks. So that's exciting. So that's slowly coming along. And I'm excited to say that the majority of my clients so far are women, which I really love, like just getting more women invested into the market. I feel like there's a lot of just like fear around investing in general. And so I think I feel like I'm doing something hopefully positive by getting more people invested. So that's been fun. On the flip side, I've been dealing with this ACL injury that Ethan had the distinct pleasure of seeing the day after it happened. I was going a little hard on the dance floor at my cousin's wedding reception at the beginning of April and tore my ACL. Got surgery a couple weeks ago and have been rehabbing. So that's been a bit of a bummer. But
I just need to ask for the group, what was the song that you broke your ACL?
The Wobble. It was a little too perfect.
Love that.
Appropriate.
Too perfect.
Oh no.
A little appropriate, yeah.
I will say, I remember this very distinctly. It was the day before my 13th birthday party. I was at soccer practice. I didn't know this, but I basically had tore my meniscus. And it was fine, and I was walking, but then the day of my birthday, I like woke up and my knee was like swollen, and my mom was like, do you want me to take it to the emergency room? And I was like, no, it's fine. So at my birthday party on the dance floor, I'm just like hopping around everywhere. People thought I was like dancing, like they thought it was a dance that I was doing. So I can closely relate to this.
That's perfect. I hope they followed along and it was like one of those line situations where like, oh, I guess this is the dance that we're doing now. That's a great story.
That's amazing. That's amazing.
The ebony hop.
Well, when Artistic Finance does any live meetups, there will be no dancing. We're going to have a no dancing policy. We can't risk these injuries.
Seconded.
Career-wise, I'm about two-thirds of a year. I'm almost at my 1-year anniversary of going back to self-employment. And not only self-employment, but somehow running 3 businesses all at once. So that's kind of fun. Van life wise, I am, I guess, digital nomad. I'm a little tired, a little jet lagged, but it's been fun traveling around and being in different locations and seeing different people. Just got back from Pro Light and Sound in Germany, which was amazing. Yeah, things are kind of cruising along.
I don't have any real exciting updates. My work situation has not changed, but I'm busy and I like what I do and I like my team and everything. So that's good. And at home, I got an 18-month-old and almost 4-year-old, and they're both doing well. We're all thriving. We have live-in guests right now. We have friends who live with us. So that has been fun. It's like an adventure. They also have 2 kids, and a dog. And so it's been a full house, but we've had a lot of fun and our kids are becoming best of friends and stuff. So just living the dream.
That's awesome. Awesome.
For me, life update. I totally overbooked myself the last month and a half. Typical Ebb. I'm really trying to break this cycle though, and I'm not going to do that anymore. But I had the opportunity to work on some pretty fun, awesome projects. Did a little bit of stuff for Coachella and also designed a musical. They were happening on top of each other, so never again will I do that. And so now I'm catching up on sleep.
And I want to point out that Live Design publishes plots of the week every week this year. You have had 2 plots of the week, and they were both awesome.
Yeah, I have. Thank you. Yeah, no, Ellen and her team were so awesome. Yeah, I feel that I'm very fortunate in that essence.
Amazing. I'm going to try to link those in the show notes because they're cool photos attached.
Thanks.
Amazing. All right. So the only
Ethan,
update
did we not get your life update? Or
I know I was waiting.
Yeah.
I was waiting for this.
You didn't answer the question yourself.
Right. Well, okay. I feel like if anyone's listened, they know that I had a son. But I guess I'll just mention it in case anybody didn't. Yeah, 6 weeks ago, we had a little baby boy named Theodore for long. And he's the cutest little thing, and I love him so much. And I can actually hear him crying in the background. So we're going to wrap this up, and I'm going to go cuddle him. Yeah, so that happened.
Congratulations.
Congrats.
Yes, congrats.
He's Theodorable.
So Theodorable. But still, nickname can be Roth-Ira. Still love that nickname. Okay, and then this week, the newsletter came out. Nicole's doing a great job with that because she's a mom and she got the newsletter out, which is sort of like this amazing thing. And if anybody listening wants to get that, monthly newsletter, you can sign up at artisticfinance.com/newsletter. And the last 2 have had photos of little Theo. So if you'd like to see photos of Theo, sign up for the newsletter because those are not going to stop anytime soon. Okay, and then I want to mention that we have a book club coming up at the end of this month. So far we've reviewed 4 books. Next month's book is The Dirtbag's Guide to Life, presented by the author themselves. You can get details at artisticfinance.com/book club. And I just want to point out that the next one is May 23rd, which is a Tuesday. Normally they're on Sunday. It's a Tuesday, and it's at 8 p.m. Eastern. Thank you to our 29 Patreon patrons. And if you would like to join and help out, I'd love your support. And you can do that at patreon.com/artisticfinance. All right. And then you can connect with everybody here on the episode on LinkedIn using their names. And then their Instagram handles will be in the show notes. So everybody here, thank you so much for your time and your energy. That's all that we have for today. We'll see you next quarter. So until next time, break a leg.
Thank you for listening to Artistic Finance, where we interview successful artists, leaders, and investors to help educate and inspire the creative community. To access our show notes and resources, go to artisticfinance.com. This show is for entertainment purposes only. Before making any decision, consult a professional. This show is copyrighted by Artistic Finance. Written permission must be granted before syndication or rebroadcasting.